so happy that this Master Investor show is so crowded. It means a lot to us at Master Investor because we really believe that investors need education and guidance. It's a mission of mine in particular. There are too many charlatans, fly-by-night people out there, and this show is designed to give investors an opportunity to avoid them, to grow their money with the big boys, both the big boys in terms of the fund managers who are here today, but also picking individual stocks and opportunities. So I really want to thank, and if everyone would give them a round of applause, the organizers who've made this happen. It's a free show, and we really appreciate your attendance. In that song that was just played, the Bird song, it says there's a time to be born and a time to die. Well, in the new juvenescent area, there is no time to die because it's not going to happen. That's a bit of a joke, by the way. But immediately after my talk, there is a panel of top people in longevity. And by top, I mean really top. We're very lucky to have them. We've got Mike West, 200 patents to his name, the leader in regenerative medicine, the inventor of regenerative medicine. We've got Aubrey de Grey, who needs no introduction, who is probably the most famous person on the planet. We have my dear colleague, Greg Bailey, with whom I've had the opportunity of starting companies and investing alongside him. And some of you may have invested in some of those companies such as Portage or Salvorex or Biohaven, all of which have yielded fantastic returns over the year. And Greg is a very large part of that. So we've got a magnificent panel, and I really urge you, I'm not going to talk very much about longevity today because we have the best longevity panel you could possibly hope for immediately after this talk. And then, of course, there's the prize, which Victor mentioned, £10,000. And like the National Lottery, which I bought my tickets in this morning, you've got to be in it to win it. So you've got to be here to pick up your £10,000 if you were the one who chose the top-performing stock last year. So please stay until the end of this show. Now, today I'm going to talk on the subject of thematic trends. Last year I was relegated to a small room, and luckily this year I've been upgraded largely by paying for the event myself, so I'm now on the main stage. But I do believe that meta themes, as I call them, are extremely important to investors in an age where the terminal values of traditional companies are being compressed. As you know, the worth of a stock longer term is the flow of its dividends until the end of until the day that you stop holding it. And most companies these days, or many companies that are successful, are not paying dividends. So a lot of the value embedded in those companies is basically hope value. And it's notable that the goodwill element on the balance sheets of many companies today way dwarfs the tangible assets of the companies. And in fact, accounting has completely changed as a result of the development of internet, biotech, and other stocks which have high goodwill but low net assets. So terminal values are changing, which means that we have to look at broad themes if we're going to be successful investors, especially with all the stuff that's swirling around in terms of economics and politics. My view is that's the fog of war. You want to disassociate yourself from the fog of war, short-termism, and look at the mega trends, and that's how you will generate huge returns. In previous years, I called it money fountains. I don't think that's a bad description of it. Focused on a couple of money fountains, and you don't need to worry about other things. So I'm going to talk about meta themes today, but as always, I'm going to start with a very brief overview of what's happening in the world today, and a description of how I see individual regions and countries developing. And the first thing to talk about, of course, is that we live in a world where returns have been skewed by the behavior of central banks and governments since the crisis, and even before the crisis, to the point where zombie companies still operate, where there's an excess of misallocated capital, where inequality of wealth results from this very process, and where the governments and central banks are so addicted to what was known as quantitative easing that even in the case of the United States, which was the first major country to reverse quantitative easing and to introduce quantitative tightening, they've lost their bottle and they've actually gone back to quantitative easing. Now, there is a direct correlation between the returns of assets, I'll show you this in a second, stock markets and other assets, and the proliferation of money through quantitative easing. And so for the short term, we can expect markets to be reasonably buoyant, largely as a result of this resumption of quantitative easing. And in the case of some countries, for instance, the Eurozone or Japan or even now China, an increase in the amount of money priming that's going on. And I do believe that this will result in inflation in due course. And that's why some of my recommendations are keyed to the increase in inflation that we're going to see over the coming years. And you should take note of that because inflation may be quiescent at the moment, but one day, according to Gresham's law, which still persists today, that good money is driven out by bad money, inflation will return, and you need to be prepared for that. Now, this quantity of money that's being produced ultimately will have less and less effect. It's like a drug addict or an alcoholic needs to drink more and more to have any effect, and ultimately the effect will be zero and the patient will collapse. So we have to be aware that this continued move to quantitative easing is not good for financial markets long term. We have consumers who are encouraged to consume beyond their productivity through financial leverage. And that's why we have a world that has higher levels of debt than ever before. And governments are among those consumers as well. And so if you look at the debt statistics, they are frankly worrying. But as I said, for the moment, the punch bowl has not been taken away. In fact, it's been filled up again. And so there is hope for continued buoyancy in the markets, but we have to be very, very careful about what we invest in, be very careful about the coming difficulties that will result in this continued maelstrom of money that's being almost helicoptered across the world. Earnings are also not as good as they were, and earnings across the world really are somewhat disappointing. You know, minus 5% in the first quarter here in the UK, minus 3 or 4% in the United States. It's not generating a huge amount of confidence in the capacity of companies to carry on growing their earnings and their dividends. But buybacks continue at a huge level, particularly in the United States, and buybacks of stock are a way of increasing earnings per share, as you're aware, and also increasing management incentives. And buybacks are at dangerous levels. They're leading to strained corporate balance sheets in many countries, but particularly in the United States. And you have to watch the level of buybacks because it's not a positive sign. Now, here's an interesting chart. This is the growth of central bank balance sheets against the MSCI World Index. And look how closely it tracks. Look how closely this tracks. Money growth equals growth in share indices. One day that growth will come to an end, and no doubt the great big bull market of the last 10 years will also come to an end. And we're closer to the end than we are to the beginning. So everyone in this room, be cautious. Get prepared for inflation. Get prepared for difficult times. They are going to come. No one can call the bell exactly, especially me. But know that we are closer to the end of the cycle than the beginning of the cycle, which is why I'm so keen, as I get back to my original point, on the meta themes that we all need to focus on. I'm going to talk about a few meta themes in my talk. I'm going to have to go really quickly because I've been allocated 25 minutes and then 5 minutes with Victor, so I'm going to talk like a verbal Concorde. Major equity indices, although having been in a bull market for 10 years, have really oscillated in the last year. We had the terrible fourth quarter performance around the world, and then this first quarter has been very good. So they're really oscillating around, which is another indication that we're coming to the end, not the beginning of the cycle. In the United States, as I said earlier, the Fed has now resorted once again to quantitative easing. Corporate buybacks are at dangerous levels. Labor markets, as they are in the UK and elsewhere, are tightening. That creates inflationary pressures, and indeed, the labor market, I think, will be the key factor in inflationary pressures in the next few years. And we have the trade war with China, which, a bit like Brexit, goes on forever, with posturing on either side, and who knows how that's going to result, but we know that trade wars are not good. I personally think that it will be resolved, but who knows with the president in charge. And you do have two megalith economies that are coming to the point of head-to-head, I wouldn't say combat, but head-to-head challenge between each other. Federal Reserve balance sheet, once again, is beginning to expand. That's not a good thing, but in the short term, it helps markets to sustain themselves, as indeed do these very high levels of buybacks that I mentioned. Now, coupled with central banks remaining profligate, we have this thing called modern monetary theory. It's anything but modern. What it says is that governments should just go out and spend as much money as they want until inflation comes along. It's propounded by people such as Alexandria Ocasio-Cortez, who's made quite a splash in the United States. Some of the things she says are great. Some of them are economic errant nonsense or arrant nonsense. Luckily, she is not eligible to run for president because she's too young. But basically, what she's proposing is what Venezuela and Zimbabwe, where the price of a cup of cappuccino or cafe au lait has risen by 2 million times in the last 2 years. She's proposing that type of government expenditure, that type of profligate printing of money, which ultimately will result in inflation, which is why, apart from all the other economic and political difficulties that we face, protect your portfolio with inflation-proofed assets. And I'm going to talk about that at the end of my talk. Here's the price of coffee in Zimbabwe and Venezuela. Inflation, and particularly hyperinflation, ruins savings, ruins economies. Venezuela has the biggest oil reserves in the world, and its people are living in dire poverty. Combination of communism and the combination of profligacy by the central bank with disregard to fundamental economics has resulted in this. And of course, even though Ms. Cortez is railing against the wealth inequality that's grown up in the last 10 or 20 years, it's her and her type that have effectively created through this process of creating false money. So today, around the world, the top 1% own 50% of the wealth. Now, that's not the same as income inequality, which is a different thing. In the UK, about 40% of the wealth is held by 1%. And that's why you're getting populist movements. That's why you're getting them springing up everywhere. It's a general sense of malaise, that it's unfair. Now, that leads some people to think that capitalism is impaired. It's not capitalism that's the problem. It's the profligacy of central banks and governments that have generated this, and something needs to be done about it. But mark my words, this populism is going to get greater, and it poses a threat to all of us in terms of us as investors and savers. So be careful about that. What we have here is my little discussion on Europe. As you know, for the last few years, I've been saying that Europe has serious problems. European stock market has reflected that. It's been a disastrous performer. European banks are down 70% in the last 10 years. They're still not fixed. The imposition of the Eurozone, forget about whether you believe in Brexit or you don't believe in Brexit, and in fact, who knows, Brexit might not even happen. Luckily, we're not in the Eurozone, because it has been a straitjacket for which there has been no escape for Italy, Greece, Spain, France, etc., as Germany becomes more productive at the expense of the rest of them. It's created enormous imbalances. There is no way, unless they have a common fiscal and monetary policy, that this Eurozone can be sustained. So one day, with Italy probably as the fracture point, we are going to have a breakup of the euro. That will cause a financial calamity to begin with, because the whole of the European banking sector, with the exception of British banks, will be bankrupt. So watch out for that. Always be on your guard for that, because that is going to be a major problem. I've talked about the target 2 balances before. This is effectively the IOU between countries through the European Central Bank. It's an all-time high. Germany has owed massive amounts of money which can never be repaid by countries such as Italy and Spain. This is becoming a serious problem. Again, watch this. This is because of the imposition of a one-size-fits-all monetary policy on a union that is not capable of sustaining it, or, importantly, of taking it further to full fiscal union. As a result, European GDP growth has slowed. Now, there's a little bit of an upturn going on at the moment, but I think that's a dead cat bounce. There's been a bit of an improvement in European shares in the first quarter of this year, but frankly speaking, with very low growth, with the major economy in Europe that's growing fastest being the UK, despite the barrage of bad news assaulted at the UK, it's amazing that we've done so well relative to all that bad news. But the European economies are just not fundamentally doing well, and they won't. They won't for a while. Their banking system remains broken. Now, here in the UK, some people talk about Brexit as a risk. Well, you can debate that all day long. I just don't think Brexit's important in this context. Much more important, and of course we are in Corbynista land here because he's the MP for this particular venue. Corbyn getting in would be a disaster, and I hope all of you have booked your one-way flights on EasyJet or whichever is your preferred mode of transport to get out of the country, because it will be a very rocky period if he gets in. His Marxist tendency, to believe that rich people are fundamentally bad, that enterprise is bad, will not be good for this country. And that's one of the reasons that John Stepek pointed out that the UK market is so cheap. And it is cheap. I believe that you should be buying UK stocks relative to other countries at the moment. But the Jeremy Corbyn problem is the main problem. It's not the Brexit problem. Meantime, in China, yes, there's a slowdown in China, but it will still grow at 4 to 5% this year. The government says 6%, but the reality is 4 to 5%. It's a wash. In a sea of debt, yes, there's been misallocated capital. Yes, there's 95 million empty apartments in China. There's lots of problems. But look at the astonishing growth of China. I can't actually read this properly from here, but I can see that in 1978, China was 2% of world GDP. Today, it's 22%. In 1978, I started Hong Kong work in 1979, quite a long time ago. China's GDP per capita adjusted for PPP was $650. Today it's $15,309. That's an amazing achievement. It's the second largest economy in the world, and no doubt in our lifetimes, China will overtake the United States. Every single year, the Chinese economy, notwithstanding the slowdown, adds the equivalent of a whole of Australia to its GDP. That's how impressive it is. I like Japan, even though it's got aging demographics. They're the best at handling it. I'm not quite sure what this robot is doing. I don't want to speculate. But the Nikkei target this year is 25,000. I have to say it was my target last year. It came very close to it, but that close is not good enough. The yen is severely undervalued. I think your currency benefit will come from investing in Japan. And the dividend yield of Japanese companies is about 2.5%. compared to 0% on Japanese bonds, which has got to be a driver of investment in Japan. They are the most efficient at miniaturizing stuff on the planet. They've got demographic challenges, but they also offer a roadmap for the rest of us with our aging demographics as to how we're going to handle that. So in a nutshell, that's my macro look at the major economic regions of the world. I'm going to give some stock recommendations and other recommendations at the end, but the bulk of my talk is to persuade you that there are some meta themes that you should look at today with a view to reorienting your portfolio. The first is the changing internet. Now, the amount of money that banks in the UK and America and elsewhere have paid in fines since the crash now amounts to over £500 billion. That's for bad conduct fines. I don't know where that money goes to, by the way. Maybe someone can elucidate me on that later on. But that's a phenomenal amount of money. And the banks are not nearly as profitable as the internet giants. So who are the regulators turning their attention to, their beady eyes to now? Of course, it's the internet giants. The internet giants that are still loftily valued, that are over-concentrated in portfolios around the world, that for some reason people still think highly of in the case of Facebook, which is a cancer on society in my opinion, a time wasters charter for 2.5 billion people around the world. At the same time as the potential for regulatory fines for these companies grows, and the fines so far have been de minimis, but they will grow and they will be across the world because governments love revenue, free money from fines and other imposed taxes. At the same time as this happening, all of them are competing in each other's backyards. They're beginning to cannibalize each other's business. So Amazon started off by being dominant in the cloud and in online retailing. Now there's Walmart is catching up with Amazon. Facebook is now moving into cloud stuff. Google's moving into Facebook's area. They're all cannibalizing each other's business, which means the profit margins, which have sustained these companies for so long, are going to be under pressure. Furthermore, the internet platforms that promote themselves as news mediums, but not as curating mediums, are actually now going to have to stop hate speech to look at the stuff that their members and others are posting online, and that's going to cost them a lot of money. So 5 years ago, Facebook had 2,000 people looking at messages across the world. Today it's 15,000. No doubt it's going to go to 50,000. Their margins are going to come under pressure, not just from taxes, but also from the fact that they're going to have to spend a lot more money monitoring what they do, and they're all cannibalizing each other's businesses. So my view, as you might imagine, is that you should think about selling these companies if you have them in your portfolio, because their day is done. And in the area of Schumpeterian accelerated destruction of capitalism, in an era of accelerated technology, that process of destroying companies is becoming faster and faster. Anyway, Facebook is my number one short. I think that Facebook is an outstanding short. If you've got it in your portfolio, sell it. If you don't have it in your portfolio and you can short it, go ahead and short. I imagine that Facebook in the next 2 or 3 years, which is ripe for plucking, which is the most evil, if you want to put it that way, of all the internet platforms, is going to find great difficulty. I'll give you an example of just the evil it can do. In the Philippines, 5 years ago, the Philippines has the highest social media use in the world. 98% of people believe that vaccination was a good thing. I think we all believe that vaccination's a good thing. Today, as a result of all these anti-vaxxers on the Facebook platform, the view is that only 20% of Filipinos believe that vaccination's a good thing. In a country of over 100 million people, that's a potential waiting biological disaster. That's the sort of bad stuff that these internet platforms, uncurated and unregulated and improperly taxed, can do to our society. The next thing I want to talk about is the mobility revolution. Some of you will have come on Ubers today. You'll have seen Lyft has gone public in the United States in the last week. You'll have walked past electric bikes from Bird and Lime and these other providers, but you won't have yet come across electric scooters for hire because they don't exist in London, thank heavens. This mobility revolution is an example of profitless prosperity that, generally speaking, investors such as us should avoid. It's a crash waiting to happen. There are plenty of names here. You'll be familiar with some of them. A lot of them are going to go public. This is a picture of bikes piled up in China because there are too many people trying to peddle the idea that a shared bike, which we've got plenty of here in London, is a good thing. It's a very easy thing to do. It's a very easy, low bar to entry type of business to get into, and the result is piles of unwanted, unused bikes. The same thing will happen to electric scooters, which are everywhere. I have a house in Brussels. The scooters litter the streets. There are any number of names that are trying to flog you to go on a scooter. Many people have died as a result of being hit by a scooter or by being on a scooter without a helmet. These are little children's scooters with motors on them if you haven't seen them before. This is a way of frying capital more effectively than I've ever seen. One of these companies, I think it was Lime, raised money at a $1 billion valuation sometime last year. And its 23-year-old founder was prescient enough to sell $40 million worth of his shares on the basis that he was planning his estate at the age of 23. What he was really planning was his exit from a way overvalued sector. The economics of this are not great. In order to charge up these electric scooters, people have to take them home, probably to their parents' house where they use the electricity. They're called juicers, in case you were interested. This is an absolute disaster. It is a great idea in principle, but there are too low barriers to entry, and many people are participating with dire effects. And then, of course, you've got the Uber, Lyft type of things. What they're hoping for is that one day there'll be no drivers. You'll get into an autonomous vehicle and they won't have to pay, as they currently do, 70% of the revenues to the drivers, and they get a commission on the way. That's a long way from coming. Autonomous vehicles are great, but they're a long way from being on our roads because it's the same factor with the Boeing 737 MAX. As soon as there's 2 or 3 accidents, the whole regulatory process will slow down, and the technology will take years to adopt. In the meantime, these companies such as Lyft, Grab, Get, and of course the big giant daddy of all, Uber, are going to be going through investors' capital at a rate of knots. I would recommend that you do not participate in the IPOs of such companies, because the people who know are the people who are going. They're the ones who are selling out to the retail investor. So beware, be careful. So it's a car crash on the way in terms of the mobility revolution. And then, of course, we also have Tesla. I heard Evil from his hospital bed today saying that Tesla was a sell. I completely agree with him. There are plenty of people who think Tesla's the greatest thing out there. Everything flashes warning signals to me. Its level of debt, the fact its deliveries were down 30% quarter on quarter in the first quarter of this year, with a variety of excuses that didn't make any sense to me. They manufacture in California, which is the most expensive place on the world to manufacture. And there's plenty of good quality car companies. GM, BMW, as examples, selling at fractions of Tesla's implied market valuation per car sold, which are going to come out with great electric vehicles. And there's just not enough electric charging points. If you have a Tesla, all you're thinking of all the way wherever you're going to is this car going to last the course? Am I going to be able to make John O'Groats without having to stop in a welcome break cafe for an hour while I wait for a charging station to work or to even open up, because there are not enough charging stations out there? This company, in my opinion, is going to go bust. I completely agree with Evil on this one. So this is a crash waiting to happen. Now, how do we invest in the mobility revolution? Well, all of these electric vehicles, and we are going electric, have one thing in common. They need lithium. They need lithium for powering their batteries. So why not invest, as the successful investors in the gold mining of the 1850s in California did, in the picks and shovels, in the jeans? That's where Levi Strauss started off in that period. Not in the gold mines, although I do like gold mines, but that's a different story. Invest in lithium. And there's a couple of lithium companies here. One is Brad Ahead, the other one is Dart, if you want to go and talk to. But I really like lithium, because there's going to be an insatiable demand for lithium. And there are not enough projects in development. So lithium is my preferred way of playing this mobility revolution, and you might want to look into it yourselves as possible investors. Now, let's talk about positive themes as opposed to what you sell. We are, and my long-standing colleague, Anthony Chow in particular, who's the managing director of our new company, which is what was called Port Erin Biotech, is now called Agronomics, Inc., are really keen on this clean meat revolution. Do you know what clean meat is? It's meat grown in labs, or plant-based meat, substitutes for meat that's husbanded in the traditional agricultural way and slaughtered. But yesterday, Anthony Chow had a little accident on his way home with his scooter. That's his scooter there. I'm not making this story up. Anthony Chow's scooter was on the ground. The keys were in the lock, and he was discussing with the lady whose car he banged into, or she banged into him, how they would exchange their details, when someone jumped on his scooter and nicked it. So he's scooterless, but the one thing that remained, and I think this is an omen, falling out of his scooter was a poster for clean meat. That says it all. The mobility revolution is not worth investing in. The clean meat, and there's been a crash, the clean meat revolution is where we should be looking at. So, clean meat. I've never invented anything in my life except for this one thing. Everyone knows what Moore's law is. The price of semiconductors comes down every 2 years by 50%, and the productivity of the semiconductors doubles. And that's applied for 40-odd years. It was invented by Gordon Moore. In the case of clean meat, the Jim Mellon law is known as Moore's law, not Moore's law, because the price of lab-grown meat is coming down on the same trajectory. And ultimately, in the future, we will all be eating lab-grown meat or plant-based meats. Impossible Burger now has a $1 billion valuation on its recent fundraising. Beyond Meats out there. There are plenty of companies that are getting involved in this area. Fish is an area in which they're developing lab-grown fish. And just think about all the positive impacts of this. It takes massive amounts of water, 150,000 liters for 1 kilo of beef to be produced. It takes a lot of land. 1% of the land that's currently required to grow pigs, sheep, beef, and so forth is needed for lab-grown facilities which will produce a better tasting or equally good tasting, slaughter-free animal product. And this is coming. This is not science fiction. This is here today. This is something you will be reading about for the next few years, as in the early days of the internet. And the number of animals slaughtered in cruel conditions around the world, particularly in the United States, is just staggering. I haven't eaten meat for 2.5 years, and nor do I expect to again until they produce the lab-grown meat at the appropriate price, and it's in every restaurant in Islington and beyond. It's coming and it's here. And the other thing that's really important to remember is environmentally, this stuff is really bad. 18% of emissions come from animals. In the lab-grown stuff, you have 0 emissions. And 80% of antibiotics, which we know are a disaster for us because the antibiotic resistance is growing up everywhere in the world, go into animals as growth promoters and to keep them free of disease. This is a really important area. It's a meta-theme, or better known as a meta-theme, that you really need to take some what's the right way to put it, some note of in your investment strategies. And then, of course, there's juvenescence. Juvenescence is our baby. That's Greg Beatty, Dec Dugan, and my own creation. It came to pass about the same time as the book that I wrote with Al Chalabi on the subject. We've raised well over $130 million for the company so far. We've got some great stuff going on. The panel immediately after this will describe in much greater detail, and probably better than I can, just the opportunities in this area. But if everyone in this room was given the option of living another 10 years of healthy, I mean healthy, not infirm, not debilitated life, there is basically no one who wouldn't take it. And if the price of that was not huge, and everyone in the world participated in that, which is what's going to happen, for the first time we can bioengineer human beings. For the first time, gains in life expectancy are not just about the environment, they're about interfering with the fundamental pathways of aging, and it's here and now. We're the first cohort on the planet for whom this extreme old age in good health is not just possible, it's probable. And everything will change as a result of that. So juvenescence is our baby, and it's what we're focused on most of the time, and we are enjoying it enormously. Right, now let's get down to the recommendations for this year. I like the Nikkei. I think there's some upside there, particularly with the currency. You must have gold and silver. You must. It's the ideal hedge against inflation and the pressures of inflation that are going to come. There are ways of playing gold and silver that are familiar to all of you, and there are some companies here, such as Condor and Oxyco, that are involved in those areas, which I recommend that you go and see. And I also like Highland Gold, which is a bigger producer that might be of interest to you as well. I believe that the British pound is undervalued, particularly against the euro, with all the pressures I mentioned earlier in Europe, and I believe that the Japanese yen is undervalued and that you can buy that with impunity at this level. If you can go short Japanese government bonds. The Japanese government is the only buyer of its own bonds, really, and ultimately that's going to end in disaster. Swiss 10-year bonds, which are negative yielding, you can also short, and the Australian dollar looks a bit vulnerable to commodity problems and also the housing crisis that's developing in Australia. And so those are macro tips. In terms of conservative tips, I'll just read out one or two of them. I think BP, after the Deepwater Horizon has changed itself dramatically, oil is probably going to remain quite highly priced. And I think Lloyd's is a good banker, is that the right way of putting it? As a stock that's got a good dividend yield, certainly a lot better than if you put your money into Lloyd's Bank. And the British banks in particular have repaired their balance sheets much better than the continental banks. Delta Airlines is an interesting one, because airlines, people never wanted to invest in them, they're far too cyclical. But these airlines are making much more money by selling air miles than they are by transporting passengers around. So Delta, for instance, is going to make $3 billion profit this year on its mileage scheme. And the same would apply to IAG, American Airlines, and so forth. The mileage schemes are incredibly valuable, and one day they'll be monetized, and they represent really the entirety of the value of the airlines. It doesn't matter if they fly any passengers or not. So Delta is something you might want to look at. I like the iShares MSCI Japanese ETF for Japan. John Stepek mentioned British Land earlier on, and I think that's a good one. Galapagos is a Belgian company. which has just got a very good results on its JAK1 inhibitor for rheumatoid arthritis. I think that company will be taken over by Gilead. Biohaven was the company first funded by Greg Bailey, Det Dugan, and myself. That's been a phenomenal success, and the investors through Portage, which was recommended here 4 years ago, are now up 85 times on their money as a result of the success of that company. And then in China, you've got Datang Telecom, and of course, you've got Woodford Patient Capital. I've never recommended that before, but I think the guy has been so beaten up, and he's got some great companies in that portfolio that we should really give it a go, and I'm going to buy some of that myself. Now, in terms of aggressive investment tips, Highland Gold I mentioned. Ceres is involved in the microbiome. It's a US-listed company. Ajax, Mike West is here. He's got a stand. There's some other members of Ajax team here. Please go and see them. This is a unique company. It's partly owned, 46% owned by Juvenescence, our own company. Portage looks interesting. It's now an immuno-oncology company that was formerly Salvarex, which was listed here in the UK and returned 6 times to investors who invested here in the UK. And then you've got Condor, which I've been recommending for years, but one day it's going to come good. It better come good because I've just become the biggest shareholder. And Mark Child is at his stand here. And very speculatively, Quebec Precious Minerals. You may remember that I recommended Critical Elements here. It was a phenomenal success. I think that has the opportunity of doing the same sort of thing as Critical Elements. And then, of course, you've got some shorts here. I mentioned the shorts in the FANG stocks, and the Australian banks are also great shorts as well. But I want to show you something. I stole this, as I steal most of my ideas, from a guy in Antwerp at a conference there. This is Wembley Stadium, or an equivalent stadium. If I stand at the top of Wembley Stadium and I drip 1 milliliter of water into the stadium, and then a minute later I drip in 2 milliliters of water, and then a minute after that I do 4, and then I double all the time, to get to 10 centimeters of water, it takes much less time than you might think. It takes 40 minutes to get to 10 centimeters of water at the bottom of this stadium. If we then go on and try and fill the whole stadium, in other words, from the bottom right up to the brim at the top, and I haven't got a picture of the stadium filled right up to the top, guess how long it will take to fill from 10 centimeters right up to the top, using the doubling principle. The answer is 4 minutes. 4 minutes. So 40 minutes, 10 centimeters, 44 minutes, fill the whole of Wembley Stadium up, starting with 1 milliliter and doubling every minute thereafter. That's the power of the juvenescence, the meat revolution, the meta trends, the reason why I'm urging you to look at these meta trends. Because they come slowly at first. They're an object visible in the sky in the distance. But before you know it, it's hitting you in the face if you haven't taken notice of it. And that's what I want everyone here to do, is to think about their portfolios. Think about the meta trends that you've embedded into your own portfolio. Think about this changing world and how you can take advantage of it. Don't let the big boys be the only ones to profit from it. And as Peter Cook said, I've learned from my mistakes, and I'm sure I can repeat them exactly, I'm sure I will. But on this meta trend theme, I think I'm right. And so, ladies and gentlemen, with that, I want to thank you for your attendance. And now Victor and I are going to spend 3 or 4 minutes just talking questions that he's going to direct at me. Thank you very much indeed.
Jim, I was in Manchester with you when you gave a talk like this to a group of private investors back in November. And it's quite interesting to note how some of the themes have changed in, 4 months. And in particular, on the macro side, the big story then was QT, quantitative tightening by the central banks. What happened?
They lost their bottle. You know, the US saw that there were signs of economic weakening, and Mr. Powell, who up to then had spoken sense, reversed his position. And now they're not introducing quantitative tightening, but they're not going to raise interest rates for some time. And they're not going to tighten the huge bloated Fed balance sheet. So that means that there's a grace period for financial assets and other assets such as art or inflated assets for a period to come. So yes, circumstances change, my view changes. I think you were going to say my meta themes had changed. No, they're very long-term views. They won't change in 4 months, no.
On the FANGs, I know you've been famously bearish on technology stocks for a while, in fact.
Yes.
And,
particularly Facebook.
Particularly Facebook, and
Yeah.
the world's greatest waste of time. So is there possibly, though, an argument that these big technology companies are in fact crucibles of the next wave of technology? So I'm thinking about Google investing in AI, I'm talking about Facebook investing in cryptocurrency, Amazon investing in cloud computing, and so on and so forth.
Yeah, that's a very good point. I mean, they're not all bad. So in the book that's being given away to some people here, Fast Forward, I talk about you only need to invest in one company. That was published maybe 5 years ago, and that company was Google, as is now called Alphabet. That is the most dynamic, most socially purposeful of all these companies. But I think Facebook is genuinely a time wasters thing, and it probably has within it seeds of its own destruction, and no doubt something will come out of it. And as far as Amazon is concerned, we know it's loftily valued. We know that it's, dominates our retail internet environment. But coming up against the rails, there are some other competitors like Walmart, which is gaining share rapidly, and its Jet.com subsidiary, and Wish, which probably no one's ever heard of, but is very addictive if you want to go on that, which is direct from China manufacturers to European consumers, and has been growing really quickly. I think it's the third most downloaded app in the last year or so. So the competition is coming along, the margins are high, the regulatory pressure is immense, and the political will against these companies is being mobilized. I just don't see any reason why you'd want to hold them, but I can see very good reason why you want to sell Facebook and benefit from its coming destruction, I hope.
Okay. Jim, how about this for a vision? President Bernie Sanders is meeting Prime Minister Jeremy Corbyn. Do you lose sleep about this? Where do we go?
Well, they'll both be in wheelchairs by then, won't they? So they won't have got the benefit of juvenescence anti-aging products, as we're not selling it to them. Look, I think we are always worried as investors about the big ifs, what's going to happen. But the fact of the matter is, when and if there is a general election campaign, all the stuff that Jeremy Corbyn's done, applauding Venezuelan leaders, meeting with IRA terrorists, going to, in fact, the memorial for IRA terrorists will come to haunt him, and people won't vote for him. I hope they get a new leader for the Labour Party. I hope they get a new leader for the Conservative Party as well, but let's not get into politics, because that is the fog of war. We want to get away from that stuff. The populist movements, however, are here to stay until something happens. I don't know how we deal with it. If you tax the rich, they're just going to go somewhere else. We need to find a way of equalizing the wealth disparity in the world, because it's too big. I noticed that Ray Dalio, head of the world's biggest hedge fund, Bridgewater, came out today and says something, we need to do something about capitalism. It's all very well for him to say that with $20 billion in the bank. But there is something to be said for
Jamie Dimon has said something similar.
Who did?
Jamie Dimon of JP Morgan.
Oh, yes, yeah. Well, they're all saying it. I mean, Davos, everyone knows what Davos is. It's billionaires telling millionaires how to think like poor people. That's what, yeah. And it's a conversation that'll be had. But leave aside all this stuff, because you can get fearful, you can get scared, you can misallocate your own capital if you worry too much about the short-termism stuff. That's why I say, please look at the meta themes. If you disagree with my meta themes and you think that fintech is a better thing or whatever, just find something that you really own yourself, research it, know where to invest, and you'll do fine, whatever the economic and political weather is like.
Jim Mellon, thank you very much for fascinating insights once again. Thank you, Jim.
Thank you.